will make people to hold on before relooking at it, as versus the expectation that new year people may relook at the extent of underperformance which we had. I think currency has been holding them back. But I think the medium term is clearly going to be a delivery on earnings and new sectors for growth to come through. That is very, very essential to attract capital. That's how I would look at it, and wouldn't look at we as we stand out. We upgraded and we have been overweight on the India since October, post the substantial policy action by the government, which continues to happen. I think good that in tough times, government is acting to lift up, do the heavy lifting, which is essential at this juncture.
Sure. Rishabh, your views.
No, I think the STT is more, as you rightly put, an irritant rather than a deal breaker. My sense is that what people would have looked forward to, and especially a lot of foreign investors, people who don't pay taxes in their own jurisdiction, find it difficult to take tax credit for whatever tax they pay in India. And for a lot of FIs, especially the larger ones, that has been a little bit of a challenge. And my sense was that people were looking for some kind of rationalization. That's why I said to start with that had they done some kind of rationalization on the capital gains tax, it would have more than offset the issue of STT. So my sense is that not that STT is a deal breaker, at least that's what I feel. But I think it's more an irritant. My sense is, as Pramod pointed out, the long-term interest of FIIs would be basically based on how the corporate earnings growth and how the overall growth in economy in various sectors happens. And very rightly, he put it that the valuation catch-up is still happening in the sense the valuation had got so wagged out in, say, end of 2024, early 2025, and that despite a year of earning growth, even if it is mild, we still have pockets which are still more quite expensive. So my sense is that it's more earnings catch-up which is happening from an FII standpoint. And especially when a lot of the other parts of the world was looking much more attractive. So I would think that STT hike is an irritant. It's not a deal breaker, but had it come with some kind of rationalization on other taxation, it would have actually helped.
Sure. Maybe a point related to the way FIs have been looking at India is, I mean, anything in the budget you think that has worked in favor of or against, India from an investment case perspective versus maybe other emerging markets? Of course, we do understand earnings and valuations and all of that, but anything in particular which you think might have helped the cause?
My sense is that the focus on continuing to build skill set, to continuing to spend money on capex, and as Pramod said, now building the next level of infrastructure in the country. I think that is very critical from an outside investor's perspective when they look at any country. And my sense is that that's really going to be helpful. Overall, I think that fiscal prudence, they've exercised fiscal prudence. People were unhappy maybe a little bit because they thought that maybe the fiscal could have been more in terms of the tightening could have been more, or you would have been, instead of 4.3, you would have been at a fisc of about 4.2 or whatever the number people had in mind. But I think by and large we are still exercising significant level of fiscal prudence. And I think overall that is going to be on a longer term basis good for the economy and good from from a prospect of investors looking at India, that yeah, we are one of the countries where you don't have to worry too much about government debt as a percentage of GDP. And they've given a clear target of trying to bring it down from about 55 odd percent, which is today, to about 50% by FY30. So my sense is that if this fiscal prudence continues, that should aid the longer term outlook on the country overall.
Sure. Thanks. Pramod, one question to you related to what they have announced on manufacturing. I mean, that is one of the main sort of pillars for growth, etc., that the budget detailed out. So within that, there were initiatives announced for semiconductors, rare earths. So in your view, what's it going to be in terms of being realistic for investors? I mean, is there uh, clearly a near-term sort of near to medium-term earnings expectation of these sectors or these subsectors doing better, and hence an option or an opportunity? How do you see that? And anything that you could maybe provide us information on?
So the way, see, the immediate terms are the ones where the budget allocations have been better than marginally better than the expectation. So those will yield. Clearly, I think defense, there was an expectation and they have maintained that 18% growth to sustain. So that's giving a confidence on the defense names in a short term to yield. Having said that, also in terms of some of the earlier policy like PLI, they have reiterated the fund flows coming through, which is good, or for that for matter, the EMS sectors, related semiconductors, doubling down in terms of absolutely putting the value. So those are the short-term triggers for those where there are numbers and budget allocation possible. But I think the bigger picture is clearly looking at as we have been missing out clearly on AI and some of the biopharma sectors which have been rocking in the global and where the large amount of FDI and investments are growing in. So I think putting in a policy framework so that the attraction comes in not only from the global players, because we still need to walk the talk in terms of getting the policies right for them to give a confidence on data privacy and all those things. But I think clearly government is looking at those sectors which are new avenues for growth, right? Because we have a decent talent pool available in both the semiconductors and in case of AI. But we need to make the attraction in terms of investment, taxation, compared to a peer sets who are offering. So I think in that context, and also to a certain extent, the chemicals, the way they have looked at, or to that extent, the rare earth, right? It has been talked about, but now putting clearly calling them out, giving a confidence for industry to walk towards it and clearly making out corridors so that it's like what they could have thought about on coal might be a couple of decades back, right? So these type of things will go a long way than just making everything boil down to a numbers to be held accountable in the short term. So I think it's a combination of both short and medium term, which is a right mix to play around.
Sure. While we did talk about some of these sectors, the other important aspect which everyone talks, and rightly so, is the sort of delay in getting a US-India trade deal, and that perhaps also has a lot of bearing, on the export sector. So, has the budget done enough in terms of, say, announcements on export sector, which will try and absorb this impact to a certain extent? Maybe Pramod, if you could answer that first, and then I'll put that on to Rishabh as well.
See, I think obviously there were some expectations that government will do some action there. They haven't specifically targeted based on that, but I think looking at, as I said, the policies both on new age sectors and also the old age ones, like textile is the one which has been relatively hurt, is what they are trying to address through the more policy action than just to give out some freebies in the short term so that it can be corrected or absorbed by the industry. So I think this government or this party has moved on from giving short-term fixes to more about medium-term type of opportunity to be built up. I think that's again a step in that direction for specifically some of the labor-intensive sectors where they need to hold on till this pressure point is behind us and might be the effort towards EU and all falls in place in next couple of quarters for that to be opening up as an opportunity.
I think from my end, I would say that you can't replace a market like US. So at some point of time, getting the deal done is very important. We can keep doing bandaging in terms of trying to help people or industries get over the temporary issues. However, I think the US market is so large and so meaningful for a lot of industries that having US shut out is going to pose a significant challenge. So my sense is getting the deal done. I don't think so. There is any other way out of it. Yes, you can maybe give short term, maybe infusion to kind of ensure that industries kind of make up for the near term pain. The other thing, as Pramod mentioned, is my sense is the other structural changes to be build ecosystem on a lot of newer age businesses. So, see, some of these businesses are not going to be built overnight. So you will have to invest over 5, 10 years to be able to build an ecosystem around businesses. So if you look at AI, or if you look at data center, or if you look at, for that matter, any of the new age, say, biopharma, companies will need to invest, and therefore you will need to provide an environment which promotes the companies to invest today or over the next 5 years, and that will start yielding results over time. So my sense is, as Pramod mentioned, there is no quick fix on a lot of these things. These are more structural things which will happen slowly as we invest as a country, as we invest as businesses, and that will start to bear fruits over time. So my sense is these are structural things where you are not going to see overnight fixes, and you will need to build confidence of people, and that's why I think that whole announcement on data center for 2047, it looked quite a sweeping announcement, but my sense is that, and I'm hoping that somebody doesn't come and change it in 2 years' time, because that's the other worry that investors have, that you kind of make an announcement and then you kind of roll it back on 2 years or 3 years' time, then it kind of really creates a huge issue. And I think that's where I think the safe harbor on GCC was a maybe a welcome thing which was come through. So it kind of gives a certain level of continuity and gives a visibility to people who are investing in India, that things won't change or things are there for a longer term. So I think that building that mindset of building things over longer term is going to be the real challenge, and I think they are providing now environment in various industries to push people to start thinking long term rather than saying that what's going to happen next quarter.
Sure, thanks. Maybe I have one or two more questions before I open it up for the participants. So, while you did mention about the fiscal numbers in the beginning, did the divestment target sort of looks, it seems to have taken a massive jump at about 80,000 crores. How do you see that getting executed, given the way markets are? Looks realistic or stretched? Rishabh, maybe if you can take that. Yeah.
Yeah, no, I think my sense is you'll have to do a couple of large divestments. I mean, you selling 2,000, 5,000 crores of you in companies is not going to work. So if you want to reach 80,000 crores, I think one thing which was pushed back, as I understand, is IDBI Bank. And I think it's gone now, clearly got pushed into the next year. And that will be one big one out of that 80,000 crores. I don't know what the number will be eventually for that. And my sense is that you will have to do a couple of more meaningful divestments to be able to reach that target of 80,000 crores. So if you want to make it, and I think that's really one place where over the last few years we have seen very little progress. We have seen government selling small pieces of a lot of companies, but it's not been largely meaningful in many ways. So my sense is that 80,000 crore number clearly indicates that hopefully next year we get some chunky divestments, including some where we actually shift control to the private sector.
Sure. Maybe a question for Pramod, not clearly budget related, but the fact that a lot of focus will shift on earnings and the way the current earning season is sort of panning out. What's your sense? Do you look at a meaningful earnings pickup, and probably that's one of the triggers? And another question is from a perspective of AI related risk, the AI trade, which has maybe gone a bit too far offshore. Do you think any meaningful pullback, and hence a lot more interest in EMs and of course towards India as well?
I think specifically consumption-led, GST-led, this is the first quarter, right, where the results are coming through in terms of buoyancy of demand. So clearly, the watch out is the management commentary, not just the results. I think the management commentary in terms of sustaining of the revival seen post GST2. I think that's where the entire focus has been, if we have to look at, in which I think discretionary, clearly some of the managements are, even managements who were suspicious about the demand are now coming up, looking at their inventory and talking about sustaining this double-digit growth for some more months or quarters. So it's a good start on the consumer discretionary, but will it follow up with others in the form of either the FMCG or others as a rub-off effect, or also lead to a private capex coming back, is still too early to take a call. At the same time, we also see, even though the balance sheets are not completely revealed in the December quarter, because of the fiscal challenges, I think there have been some payment-related delays which are happening for infra and related government activities, which is more a short-term in nature. But I think in that case, where the medium-term policies clearly give out a direction to find the momentum. Broader macro in terms of global versus local, I think definitely the delay in US policy or the US trade deal is still the overhang for us than specifically the AI. We haven't participated in AI to that extent. For example, I think Indian beta market beta has further collapsed in the last 18 months versus the what has happened in the global versus the way we haven't participated in the rally at all. So hence, even though if there is a shakeout, there may be challenges, but I think if you look at the global results of Meta or Microsoft, they look on the face of it very, very strong, right? So in that context, imagine such a mammoth organizations giving you uh, double-digit growth on both top line and bottom line. So whereas we are looking at to come to a flattish or to a single-digit growth. So I think to that extent, it's more about delivery versus expectation than the absolute delivery itself. I think the delivery on some of these new age economies globally has been very, very strong. To that extent, I think the analysts are still grappling to catch up with those numbers. But I think it's more about valuation versus the allocation in terms of concentration of those deals. For us, I think we haven't participated. I'm not sure how much we will do it the other way trade when it happens. So I think we need to focus on where our strengths are. And in that context, this budget brings the focus back into getting the policies to participate in some of the engines of growth globally to which we missed out to partially, and also to where our strength is both in terms of building capability for and the productivity to participate in the global supply chain.
Sure, thanks. Rishabh, a question related to your portfolio management. I mean, that part of what you do in terms of any tweaks that you see from your strategy perspective, given the way announcement in the budget have come out, not from an immediate sense, but trying to maybe make certain changes to the portfolio from a more medium-term perspective. Any take on that?
No, I think broadly there was not much in terms of change in the current structure of what government has done. As we mentioned earlier, I think the consumption push came last year via GST cut, via the tax cut. We are hoping that that kind of follows through in terms of demand. As Pramod mentioned, we're starting to see a few months of reasonably strong demand, at least in some of those sensitive sectors. And hopefully it kind of follows through because that's very important from where we stand. Also, what happened last year was you saw a lot of maybe not last year, but the year before and the end of last year, end of 24, early 25, was a significant tightening by the RBI on credit and personal credit. And I think that kind of shifted over the last 6-8 months, and as interest rates have also come down. So I think all of these combined hopefully should continue to help consumption. I'm still not sure on capex because there is still some slack. Both globally, China is pushing a lot of stuff into India because they can't push it into any other part of the world, and also we are not able to push our exports the exports are not really, if you look at export numbers on goods and goods, not services, that's not great. That numbers are not looking great. So that slack is getting picked up from a perspective by local demand. And therefore, that's why you're not seeing any inflation in India. So my sense is that no specific to budget tweaks from a portfolio perspective. Of course, there are some industries that we had on the radar, and maybe we might do more work, but nothing specific to related to the budget.
Sure. So I'll take a few questions that have come up in the chat. Participants, while I do that, requesting you to post your questions in the Q&A window so that we can post them to both our panelists. So one question is on the impact of a higher borrowing program on PSU banks, if any, in terms of earnings or treasury gains reducing or losses, etc. Is that why you saw the PSU bank pack sort of correct quite substantially yesterday? Maybe Pramod, if you could take that, and Rishabh, anything if you want to add to it post.
No, I think the credit cost is a challenge, especially for the PSUs which have been relatively outperforming to the private to that extent. And I think it's not just for them, I think it's for the entire ecosystem. And where at the one side, RBI is cutting the repo and making the loan rates come down. But I think actually on the ground, the borrowing costs are still elevated, and this adds some more relative pressure on the same. Clearly, I think the reaction for PSU banks and especially large ones like SBI is also, which has a decent amount of CASA, also showing that stress is in that direction. But the only point to look at the market borrowings is one, on the face of it, it looks higher. But I think even last year, they have been able to undershoot that number versus the projection. So we need to see how things will progress as we go forward. Initial knee-jerk reaction has already happened. Instead, we are looking at the opportunity to upgrade some quality names within PSU banks as compared as this redressal happens.
Sure. Rishabh,
No,
anything from your side?
no, not much that I can add more than what Pramod just mentioned.
Sure. Another question is on the defense sector. So while, of course, the outlay or allocation or expenditure on defense has gone up, the question is around why is it reacting on the downside despite a significant increase in allocation? So has that got to do more with the way the stocks are valued today, or is there more to it? From Pramod, maybe if either of you.
Yeah, Pramod, you can go and then I'll maybe jump
Yes.
in.
No, I think the expectation had built up before the budget, right? I think those are the only stocks where clearly the outgo is related and hence it can reflect. We have been very selective in names. We will remain so in the short term. I think it's more about continuing the same high double digit or I would say high teen growth maintained as compared to which I think market expectation was also similar. So it's like unless until you a big beat you see otherwise it's like meeting expectation is as good as like inline performance or sell on the news type of a thing, which might be happening in the short term. But I think structurally there is clearly that sector which we remain overweight and quality names we would look at. And I think any dips there, we would be more biased into that names. Yeah, over to you, Rishi.
No, I think, yeah, as Pramod mentioned, I think it's more expectations that were there. And my sense is that government has a couple of very large programs, purchase programs coming up. So I think they will need money for that. So my sense is, I think the almost, I would say 30% of the incremental capex was actually to defense acquisition. And my sense is that that's primarily coming from also some of the needs they would have felt last year after Operation Sindoor in terms of rearming some of these forces. So my sense is that you're going to see that continue. However, I think as Pramod mentioned on the names that the expectations were built up, and some of this is not cheap. So I think that's also you should keep in mind in terms of the valuations.
Fair. We have a question on the currency. What do you think of the currency issue where we are weakening? Was it not imperative for the budget to give messaging and measures to welcome FDI, FI money by showing a lot more attractiveness? Is this not a negative? Or in a way, a lost opportunity, which has to be viewed negatively? Rishabh, maybe we hear you first this time.
I'm not a currency expert, so I don't know. As somebody said, you can't control everything, right? So you can control interest rate, you can control fiscal, but then you have to let go of the currency. So, and the fact of the matter is that the numbers don't stack up. So if you look at FDI and FPI flows, both have been very weak. In a capital short country, we are running a position where you don't have net FDI. Gross number of FDI is still okay, but the net number is very poor. And of course, you are seeing FPI outflows. So you have this pressure on the capital account on the fund side, which you and keep in mind we have gone through a much lower oil prices during this whole period. Of course, I think gold has kind of made up a little bit for the oil, but by and large, I think the lower interest rates means that your ability to defend currency is that much less, and therefore I think you can't control everything, so you had to let go of the currency, and I think that's what has happened. Thankfully, because of till now, at least till about a month back, lower commodity prices did not kind of translate into higher inflation, and I'm hoping that that continues.
Sure. Pramod, you want to add something to this?
No, Rishabh has covered it. So thanks for covering it up, Rishabh. I'm not good at it. Thanks.
Okay, a question on non-ferrous metals. Will this budget benefit local metal players, especially the non-ferrous metal players?
I think Pramod, you can take this.
So I think we have been upgrading names in the non-ferrous for some time, especially the steel names, which I think there is some policy action awaited in terms of protectionism, how that will pan out. But looking at the valuation where that sector is in the new context of broadly protecting the domestic producers, I think valuations we feel have bottomed out earlier than the traditional price to book basis. So we have been turning positive across the steel pack since I think November onwards. We continue to build up on the same. Even though the steel prices have started moving up, there have been some noises clearly being made out by the domestic consumers that the protectionism is not working the way it is supposed to and putting a pressure on them. But I think clearly as a sector, it was neglected and it's coming back into force. We feel if the real discretionary spending is to come back, we see some potential of assumptions on demand also on these factors to come in, not just the price point on this commodity. So we have turned clearly positive after 2-3 years of being negative on those non-ferrous names. Not specific to budget, but I think structurally we have been looking at it.
Sure. Either of you has any view on gold and silver, the way it rallied also and the way it's been moving the other way in the last few days? Do you want
That's the short way to lose your job, man. No, I have no view. I have no ability to view, and I have no view on the bullion prices here.
Just on a lighter note, I think these are like what 8 sigma, 10 sigma events which have happened. So I think
Exactly.
even if we are tracked, it was impossible to absorb such events. I think it's better to
Yeah.
avoid.
I completely agree with Pramod. I think it's very, very difficult to predict some of this stuff, and it's beyond our understanding or what we see around.
Sure. Any sectoral preferences from both of you in terms of where you would want to probably put in more weight behind your allocations? Not budget specific in general,
Yeah. Yeah, my sense is that, and we have been consistently saying this, that one cycle that we saw post-COVID is coming to an end, or as ended. So, as investors, we will have to look through on some of the newer companies, newer areas, newer names. Flogging the same horse is not going to work as investors, and therefore, you will have to think differently, and you'll have to think um, out of the box in terms of what the next cycle or what next set of businesses that will do well will look like. Just because something had gone up and is now down 20, 25, 30%, and then you go and buy it, it's not going to work. That's at least our view of the world. That as investors, you will have to think about newer names, newer companies, newer ideas. The good thing is that some of these newer ideas are actually cheaper because there is still not crowding out trade. So they are not owned by so many people, or they are not really in terms of ownership much lower in terms of overall scheme of things. So my sense is that that's how I would put it. That the cycle that we saw post COVID, say 2021 to 2024, 25, I think that cycle by and large is come to an end. And as investors, we'll have to think about newer ideas, newer companies to kind of really make money in the next cycle.
Sure. Pramod, your sectoral preferences?
No, clearly, I think, as I indicated, metals and mining is what we have upgraded. We are much more selectively looking at chemicals post the substantial rundown which has happened. But those are more like more company-specific commodity bottoming out and valuations becoming normal, and how that company is positioned. So we are more selective in chemicals. We are looking at some more constructively on cement. Large companies seem now better to participate in the growth across the country as the next phase of momentum is coming up. So those are the couple of names. Otherwise, we are overweight on autos, broadly defense and financial services and power. Those are the specific sectors which we have remained overweight, and we are doing incrementally on the sectors which I called out on upgrades.
Sure, thanks. Participants, if any questions, please do post them on the chat. Someone's asked a question on nomination of the new Fed chair. How will that impact Indian market? I don't know whether you'll want to take that.
No, I don't think so. I mean, I can't even figure out with the new RBI governor what needs to be done. Forget Fed chair. So I think it's as I say, beyond our pay grade.
Fair enough. So I guess that's all we have in terms of questions. I think thank you. It was an interesting session, and thanks for sharing your insights. Hopefully the participants have also found it informative and as interesting. Thank you, everyone. That's all on
Thanks.
this call. Thanks, Pramod. Thanks, Rishabh.
Thank you.
Have a good
Thanks,
day.
Aurav. Thanks,
Thank you.
Pramod. Thanks.
Thanks,
Bye.
Sushil.
Bye.
Bye.